Today we're going to continue our discussion on yesterday's highs and lows and focusing on time and price. Stay tuned, traders. We'll be right back. Good day, traders. I'm Stacey Burke from Stacey Burke Trading. It's Tuesday. We're already had a good start to the week yesterday on the British pound crosses. Almost a replay of Friday on a few of the pairs, and we're going to go and analyze those trades. We're going to look at exactly how those unfolded, how they could have been traded, the trade that I did take, and then also we're going to be talking about how the week is potentially setting up and how the calendar, the news calendar, may also tune us into some of the pairs that may move. We're going to discuss narrow range days again. I had a few questions about narrow range days, and we're going to talk about again the three things that markets do, and we're going to look at some specific examples of yesterday's Monday market on the British pound, and we're going to be specifically talking about the same things we talked about last day to clarify some things regarding yesterday's high and low, but also the current day's high and low when those previous borders don't get broken. Now, just to re-emphasize, we sent an email out yesterday. I'm going to be a guest on Pepperstone's Professionally Speaking webinar on October 15th with Weston. We're going to be talking about Brexit as we're getting closer and closer to that. I think there's going to be some significant opportunities in the British pound as well as some of the cross pairs. We're going to be looking at the equity markets, S&P, gold. As we get towards the US election, we could see some big trends start to develop that could ultimately continue, or we may see some volatility depending on how those election results build up and play out. Chris is going to be going into some detail regarding his specific macro trading strategies, and again, I'm really honored to be a guest on that. They've already just contacted me this morning. They've already had a huge response, so if you haven't done so, book your spot for that webinar. I'm going to include the link below if you want to go ahead and do that now. But again, thank you for hitting the like button. Thanks for all the great feedback and questions. And again, I apologize if I haven't answered your questions specifically, but I will endeavor to try and get through all of those questions and comments if I don't address them here on the video today. So last day we spoke about the importance of the previous day's highs and lows, and I talk about conceptualizing, just picturing yourself in a big box. Okay, we're not even going to talk about round numbers. We are going to look at that on today's video on the charts, but just picturing price. If price is contained inside of this box from the previous day's high and low, as the new day evolves and the market has gone into consolidation, if we have not broken out of one of these boundaries, the current day's high and low become the important areas. Now, we've started a new week. I've talked about narrow range days, and I'm going to clarify. There's been some confusion. A lot of traders thought I was talking about narrow range bars on the 15-minute charts. I'm specifically talking about narrow range days on the daily charts, and we're going to look at a pair that's setting up right now on one of the crosses that with the calendar this week could potentially have an explosive move. We have a double inside day. That's two narrow range bars. And when the market coils and compresses like that, there's a huge potential that we're going to see a big move come out of that coil. Now, when we go into consolidation, especially at the beginning or the end of the week, that can mean a couple of things. We could be seeing the market poised for a continuation, or in a lot of cases we see the market poised for a reversal after we get those narrow range days. But when we go into the consolidation and we head into the next 12 candle window, and again, just to clarify, a bit of confusion, somebody asked me if it's every 12 candles. The 12 candle window is from 8 to 11 p.m., 2 to 5 a.m., and 8 to 11 a.m. for me, New York, Eastern Standard Time. Okay, so that's the hour before the equity markets open, the hour of the equity market open, and the hour after the equity market opens. Now, conceptualize the first hour will often start to expand that range. In some cases that may be to hit stops, and remember we talked about where the money is. It may also be just to start to expand the range, so they may go up, and then as we head into London they may go down. And what we have now is that we have a new low and a new high. So traders need to understand that that range expansion itself is not necessarily where the trade is. But if we have a low of the day and a high of the day that the market trades into and then works its way down into, the timings then become the most important thing. Okay, so timings. Think about, we talk often about price and time. Algorithms work on time and price. The first thing that the algorithms will want to do is move the market because there's stops. And this contraction phase generates contracts and trading in between, but the timing factor regarding the algorithms and bigger traders and the other time frame traders, London, New York, the other sessions coming into the market, they're going to go to where the money is. Call it liquidity, call it stop hunting, call it fundamentals, whatever, but they're going to go to where the money is. When the market expands, the timings are what's important, because as I mentioned last day, that hourly rotation, okay, is what's important. That first hour will often be the trap and the stop hunt. Okay, specifically when we see a level broken on a 1, 2, 3, that 3 bursts, whether it's the first candle against the move and then 1, 2, 3 to the high or to the low, or 1, 2, 3 or 1, 2 and a doji and 3, 4, in that hourly rotation, as we head into the second hour, whether that's Asia, London or New York, that second hour is the equities hour. That equities hour will often open. Think about the equity markets. If they're going to go up, they might take the traders down into the open before they reverse it. And often that reversal, as we saw yesterday, can be on the second or the third candle. That third candle engulfment in the second hour is potentially now setting up that hourly candle as a pin bar reversal. That pin is a stop hunt down either into the numbers or into traders that are already long from the previous session on Friday. If we're at the low of the day, it's hitting stops from traders that were long in the morning that didn't take money off the table, or they've gone to break even, or whatever that may be. But it also triggers breakout orders. Traders see those bursts heading down and they'll hold it down there. Yesterday they held that first candle down and the second candle down at the low of the day until the last minute of that 15-minute rotation before bringing it back up 9 pips to create that engulfment. So it was hanging down here, enticing traders, making it look like it's going to go on a runaway move, getting in at the low of the day before pulling it back, locking it in, and then we watch the market go bang, bang, sideways, bang, 50 pips in 4 bars, so 1 hour. So we've got 8 hours of this creeping back and forth, and then in 1 hour, 50 pips. Okay? Same replay, a different variation of Friday's chart they broke the previous day's low. Now that's something we need to clarify. So again, some simple concepts to remember. Yesterday's high, yesterday's low. If we don't break those levels, and we have today's high and low, let's come back to a simple understanding. If they break yesterday's high, the first place they'll come back to is today's low. Today's low. As we go higher, this low becomes the new boundary for our low and our high. If they break down and break the previous day's low, today's high is the new boundary. So we've got a new low, and they'll come back to today's high. If they break through that and layer on top, they're going to keep going to take out the previous day's high, as we saw on the inside bar case on Friday. They'll break the low of a day, and if your other time frame traders are in the market, chances are they have stops on the opposite end of the direction that breakout trade is going. So often when those markets are opening in the equities hour at the extreme, they're catching traders at the furthest point away before they lock it in and then shift the market back in the other direction. So again, coming back to the psychology about what's happening, if they break a border early and they hit stops, they're going to come back 25 to 50 pips, okay, to put that into traders who are in the breakout. If they get you on the open of the equities market and you're caught in the wrong direction, they're going to go back 25 to 50 pips the other way, especially if it's 50 pips to the high of the day. So if it doesn't hit yesterday's high or low, the next most important boundaries are, again, I'll clean my whiteboard off, today's high and low. So if we haven't broken an upper or lower boundary, but we've got a high there and a low there, and we're coming out and we're bursting down, okay, we're at the low of the day. We're now focused on time of day. Time of day. And then that hourly rotation. Was it the first hour that broke down? Did it break out and then London pulls back? Or did it hit the stops up top or break down and London opens up, hits the low, first candle, second candle, third candle engulfment, fourth candle reversal, whatever that may be? Time of day is critical. So that's really important to start to sort of process that in your mind, to understand as the clock is turning, time is more important. Once we've hit those boundaries, the timing is critical, because we're either in a breakout or they're working one side to trap traders in the wrong direction before they move the market in the other way. And again, it comes back to looking at our daily template, our daily charts, where we're at in that weekly template. Yesterday was Monday, day one. We broke to new highs. So potentially now we're into a new week. We may be moving back towards a week's previous highs from a few weeks ago, because there's gaps there where there's profitable trades. And again, we keep talking about this. Where's the money? Where are the gaps? If there's traders on the daily time frame, 4 hour, whatever they may be, if they're still in profit or there's a gap there, the market may be moving back there to fill that gap. But before it does, it might come back, hit stops before moving away again. So again, we're always looking at the time of day. Are we at the high or the low? Have they hit the stops? Has it broken out? Whatever that may be. Because we know that markets only do three things. They trend, they break out, they pull back, and they trend, like we saw in the pound yen yesterday, and we're going to look at that chart next. They break out, they pull back, and they reverse, stop hunt in the other direction, false break reversal, or they break out and they pull back and they stay in a trading range, which to some degree, pound Aussie yesterday was somewhat like that. It stayed in a 50 pip box, give or take a few pips at the high and the low, but it basically traded in a 50 pip trading range from Friday's trade. So hopefully that makes sense. Again, October 15th, Chris Weston and myself, Pepperstone, we're going to be talking about all things markets. We're going to be looking at a lot of the global markets, the Brexit scenario, what my perspective is on what our opportunities could potentially be. I think it's going to be awesome. Last time with Chris Weston is an unbelievable source of knowledge. If you ever get a chance to get him talking about markets, he will blow you away with what he knows. And he's already shown me some stuff that he's going to go through next week. So I'm excited to hopefully share the mic with him and hopefully offer a lot of insight to other traders. We're going to be going over some short-term strategies as well, and how possibly that can be an opportunity for us to capitalize if we head into some big moves. So again, just to rehash today, yesterday's high and low. If we haven't hit those, I'm still working off the extremes inside of this day. We'll look at the round numbers, how they play out. We're going to look at that on the charts, because yesterday was a perfect example of how a couple of the pairs did not go to the extreme, but they were at the low of the day and they traded into round numbers and they immediately went back through to the high of the day. And again, engulfments and pin hammers. Understand the psychology of that price action. When we get an engulfment in those timings at the high or the low, they are locking in that level for the time being. The pin hammer is the last stop hunt into the trade that is in the right direction. If they have locked it in and they're going to move it, they are not going to go back, because once they have the money locked in, if they go back, they allow losing traders or traders that are now chasing the wrong direction to get out of that trade without taking a loss. And the name of this game, it's a zero-sum game. It is not us trading for world fundamentals and economics and all the trends that they want you to believe. They are out to get your money. It is you against them. When you start to understand this, you step back and wait for them and then piggyback on their moves. So hopefully you got some value out of today's video, traders. We're going to look at yesterday's trades, and we're going to look at the daily charts as well, and look at some of the narrow range bars. Again, to clarify, those are daily charts that I'm looking for the narrow range. Yes, we can see those on the 15-minute charts. Very, very easy to see. They lock in the high, they lock in the low, and they go sideways inside of a 75 pip range on most occasions, somewhere in that area. But on the daily chart, when we get those compressive patterns, we could potentially be heading towards a couple of days or maybe even a bigger trend as we head into monthly end of month rollovers for bigger moves. So again, thank you for hitting the like button. Thank you for a tremendous amount of feedback. Thanks for your patience as I get through emails, and last week was really hectic here. We're going to have some great moves. Be patient, be disciplined. There's going to be 50 pips a day, probably 4 or 5 times a week at least. There's 2 sessions a day at least that will move. So you're looking at 3 or 4 really good trades. If you focus on the best setups and just patiently get consistent of those, get your confidence, understanding the timings, the levels, bump it up slowly, just keep building your confidence, your discipline, and a winning mindset. Compound those trades. Let the compound effect eventually kick in. These trade setups are the same week in and week out. So have a great trading session, and may the markets go with you.
Good day, traders. Stacey Burke from Stacey Burke Trading. We're talking about time and price, and yesterday's high and low and today's high and low, and we're just reviewing, going over our daily chart and looking at Monday's trades as well as today's. So I talk about the narrow range day. The blue circle is a narrow range day. I've reconfigured my settings a little bit. The green and red bar are inside bars. So basically, narrow range day can be an inside bar or a day that is not an inside bar, but it is a narrow range day. They have very similar potential effects. When we get a double inside bar or even a combination of inside bars, we can see that they can be precursor possibly for a big move or a reversal. And a lot of these narrow range bars are at the beginning or the end of a week or near the high or low of the month. So again, we're not going to go into depth today about the monthly rotation, but just talking about the narrow range. And so we look at the British pound. Friday was an inside bar. So we had a narrow range, a combination of a 3-day narrow range pattern at the end of last week, at the end of the previous week, heading into last week. Then we saw the breakout of that range, and then the next possible obvious target is the high of that week. Would be the date of that is the 16th of September. So you can see we're working our way up there right now. And again, the inside bar, we've broken out. We've gone into consolidation, broken out again. First bar of the month, inside bar. So not getting too much into the beginning of the end of the month in this video, but that can be a significant time to reverse or continue moves. And there's a number of reasons. They lock the book in, they lock their profits in, whatever, for the end of the month accounting. We get futures rollovers, options expiries, all these different things. But that's a topic for another video. Whether you use candles or bar charts, it doesn't matter. I tend to look at both. I like I like bar charts for dailies because I can just, again, I want to emphasize, I'm going to blow this up. I want to emphasize the psychology of when a bar's high or low is broken. You'll notice that a lot of these bars, they break out and they pull back inside of a range. Now we have in market profile, they talk about a market being out of balance. A market that stays closed outside of a previous day's range is an out of balance day. And out of balance days have the potential to become large trading days because they, if they reject coming back into the value area or into the previous day's range, they may often go on a run. But if you look at a bar chart, you can clearly see that, again, inside day, no borders were broken on the pound, but it still gave a good trade yesterday, which we're going to look at. But again, that was Friday. And then Monday's market broke out of the inside bar, but also broke above the high of Thursday, and that was the first day of the month, and we're currently above that large range bar. So we could potentially either have a market that's going to reverse today, or again, we have breakout traders up here in September that broke out that are still sitting in profit, and we're looking at a market that's, it's well over 100 pips away. So just the psychology, I like to look at my daily bar charts. And again, whether you're looking at candles or whatever, it doesn't matter. But we had an inside bar after a big move up, consolidation, inside bar breakout yesterday. So that narrow range bar on Friday, we may have seen the beginnings of possibly a strong move today. We're going to look at those charts now. Now, again, you can go through your daily charts and, again, I look Monday to Friday. It's day 1, day 2. Today's day 2. We're looking at the pound. I did not trade the pound yesterday. Funny enough, I'm going to show you the trade. I did take on the pound Aussie. I originally was going to go into the pound long, and funny enough, I didn't think it was going to move as well as the pound Aussie, and we're going to talk about that. But we went up to the previous day's high at the beginning of the session. Okay, so we went up there. They barely touched it. They pulled back. So again, just psychologically, traders may have been long. They're holding on. There may have been take profit orders sitting up here from the longs on Friday night, and you'll notice they didn't really let them get out. But that market also turned off of the numbers, 50. And when did it happen? In the first hour, 1, 2, 3. And they came back, and they went up again. And they went up a third time. So understanding 1 push, 2 push, 3 pushes, and they still didn't take out the high of the day from Friday before rolling back over. Now, so no previous day's high or low has been broken. The market falls over. We have a higher low in Asia. So again, as the market moves higher, get comfortable and familiar with identifying where swings are, because that's where traders are taking those trades. And if they're taking these trades and following them up and chasing these moves, we have stops sitting at all these higher lows. And what does the market do? It comes back, falls over, and into our Europe 12 candle window, we get a 1, 2, 3. So again, visualize this is 5, 6 candles, but it's still a 1, 2, 3 down. And when did that happen? In the first hour, and we open up at the low of the day. The first candle is the bear candle of the London equities session. Timing. These algorithms, whatever they may be, but most assumably they're algorithms. It's the same thing every day. They kick in at a certain time, and where do they go? They go to the higher to the low, to expand the range, to hit the stops, to trigger breakout orders, to hit take profit orders, to cover positions, whatever that may be. It's irrelevant. It just, the market's going to move. But also conceptually understand when we're at the low of the day, and we have a first candle of the second hour, and then the second candle pins higher and pulls back. Open test rejection, but the market has opened up down low. Traders have chased this short. The third candle engulfs the first candle of the equities hour. Okay? It's an engulfment with pin, hammer. An engulfment pin hammer at the low of the day. Yes, somebody asked me, so no trade because no borders were broken, higher low. No, that's the low of the day. Last day we focused on purely on the blue line as the previous day's high and low. Just for simplicity's sake, this is the same trade. It's the exact same trade, but instead of the high of the low of yesterday, it's the low of today. It's the same trade. We get the engulfment, the pin hammer. And again, I want you to understand when the market is going to do a stop hunt, how fast that happens and the reason why. They've got all these traders chasing the swings, chasing the swing, chasing the swing. They move quickly because these traders, when this market moves fast, catches them off guard. It catches them in negative equity. The market's been moving slow. They're just waiting. They're going to break even or whatever they're going to do, or they haven't taken money off, or they don't have a stop, or they're moving their stop, or they're averaging into a losing trade, whatever they may be doing. And it goes fast because they're going to get the money. They want to stop these traders out before they have a chance to even know what happened. So again, this market, four bars, 50 pips. But you'll notice also, where did that occur? At the round numbers. Okay, so we've talked about this over and over and over again. 50 pip box. The pound loves double zeros. It loves double zeros. Equity hour, the middle hour. First hour is the trap and the stop hunt. 1, 2, 3 reversal engulfment. You're going to see this 3-bar pattern over and over and over again. Timings. Understand the importance of the clock. You don't have to be chasing this stuff. Like, somebody's shorted this market. Maybe they got 50. Maybe they shorted it here, or maybe they're sitting in this market for hours. This is over in 1 hour. After this, I don't even bother looking at the U.S. session. I mean, some days I do, but it's a Monday. Chances are this market could have kept trending as it did but in a large majority of cases, they will come back to put heat into a position. So we talked about this in earlier videos. Take money off the table. If you get 50 pips in 1 hour, take money off the table. You can get back in. This is 1 push, 2 push, 3 pushes. And guess how long that took? And where did it take you? It took you into the next 12 candle window. 1 push, 2 push, 3 pushes against the trend. And then a 1, 2, 3. Okay, that's a stop hunt pattern. That's a stop hunt into the traders that are short. And then 1 bar, bang, gone again. Now this market moved up 25 pips in the U.S. session before going into sideways consolidation. And again, on our daily chart, we saw the inside bar from Friday. And the importance of possibly a big compressive move if we take out the outside bar. So again, we'll just dial this in a bit, tidy it up, move that over. There's other little bit of information I want to show traders. Okay, so we've come up, triggered the high of day. They've gone up and hit it again, and now they're coming back down. Now, this market is staying up high. It's staying up high. There's a high probability that we may see this market continue up through the double zeros in a trending scenario. If it breaks down, we could see a breakout first and then a stop hunt back to the low of this range before continuing up. But this market, if it breaks down and pulls back, then we could see it revisit traders who were in profit from yesterday. But again, we had that inside bar Friday. We had a breakout of that yesterday and close above, and we've gone into consolidation sideways. There's a high probability that we could see this market continue to move in that direction. But the double zeros obviously will be key. Just coming back though to this move down, a lot of traders have asked me, moving averages, why I don't use moving averages. And, I occasionally do flip some stuff onto the chart. But when I'm looking at the setup, I always want to have a blank chart because I can see the low and I can see the high. If I have a lot of other stuff on my charts, this gives you analysis paralysis. And why is that? because this looks like a trend, and nobody wants to trade against the trend. Indicators, the moving averages are down, stochastics, nobody will go against this unless they understand what's happening here. They hit the stops, they go sideways, they engulf it. And it's the timings, it's the equity hour. They got people down low at the open of the equity session. These traders, money sitting up top here. We saw the same thing happen on Friday. Okay? Same thing happened on Thursday. They dragged traders up before they dropped it down. And then they went back up and got them again. And then they brought it back down. What indicator is going to get you back and forth? And why do you need that? You don't. If you focus on the 12 candle window, specifically on timings, and you understand when they're at the high or the low, and what time that has taken place at, and what's already transpired in the session, your confidence will skyrocket, because this is a very simple system. We got double zeros, we got timings, the high and low of the day, engulfments, and pin hammers. It's very straightforward. So we're looking at the pound Aussie, and this is a trade that I did take. And I'm going to answer another question that I received as well. So we had our blue line up top. Our blue line down below was another almost 100 pips away from Friday's low. But as you can see, the market gapped down in the open on the rollover below the 50, round numbers at 50, pulled back into it, went down again and made a low of the day in the rollover prior to the Asian 12 candle window. We then went sideways and had a lower high set up. So again, just common sense. When we get lower highs throughout the morning, think about what's happening there. Okay, stop. As soon as you see these lower swing highs and we're near round numbers, low of the day, this is textbook. They hit the stops up top first, then they went down. Now my belief at this particular time, I looked at the pound yen and the pound in this pair, and I just thought the pound Aussie was potentially going to go right back up to the double zeros. Maybe a pullback and continue. I thought it was potentially going to be a very strong move. And I was about to put a position in on the pound and the pound yen. And again, just to answer a question, somebody asked about trading multiple pairs, and was I worried about having corresponding pairs trading together? I don't often do that. I usually will focus on one trade, and I'm just willing to accept that as normal, the other pairs will move better. But as long as I get my reasonably good trade and I execute properly and I manage my downside and I, it's profitable, then I'm okay with that. You win some, you lose some. You're not always going to get the biggest move. I'm not worried about that. I'm just worried about mastering the particular trade setup that I'm in and making sure that I don't do anything stupid. So again, we had the 1, 2, 3 up. Then they came down, and this pin hammer is at the open of London. We pinned through the double zeros. We're at the low of the day. We got 3 levels down, 1, 2, 3 lower highs. They hit the stops up top. That gives us our outside structure. So again, outside structure is for our middle M and W, and I will often target 2 times that move as a minimum. So I felt comfortable that that was well beyond my 50 pips. But again, the high of the day is the first place this trade could fail, and it did initially fail at the round numbers. So somebody asked me, do I get in before a candle closes? That is a very specific question to timings. So again, this candle was the first candle of the hour, and I was prepared to wait for the second candle, thinking we may get an engulfment on the second candle. When this candle was hovering around the zeros in my third 5-minute bar, there was about 2 minutes, 3 minutes left. I can't remember. We'll have to look at the 1-minute chart. I decided to enter the market. We'll just bring this across. Sorry about that. We'll go back and look at the 1 minute. So when this market was coming back through the zeros, there was about 3 minutes left in that 15-minute candle. I entered the market. I felt that we already had the engulfment. I'm not encouraging you to use the 1 minute. I'm just saying that we were at the low of the day. We had an engulfment. We had an engulfment and a pin hammer. And as the market came back through, I was trying to get filled as close as I could to the numbers and got filled at 03. Again, at that point, the pound Aussie had been moving stronger, but in the next 15-minute bar, the pound yen and pound moved actually better. And we see the little doji here. Then the market broke. And I still feel like even though this was a 1, 2, 3 up, it seemed to hang around that 25 mark for a while. But again, it moved its 50 pips. But you'll notice, again, I keep emphasizing master the 50 pips because you'll often hold on for more. And this is not the type of day you want a breakout trending day. You want a move that's trending. We're in a beginning of the week in a range-bound market. Take your 50 pips, let it reset, and come back for the next session. We get another W heading into the U.S. session, and engulfment and a pin hammer. And although this market moved 50 eventually, as time decays on, I'd be happy to take 25 in the U.S. session, especially if the market gives me that inside bar. I think it's just one of those things on a Monday. We don't know. We're not in a breakout trade. We're in a trading range. So coming back to the three things that markets do, they break out, they trend, they break out, they pull back, and they reverse, and they break out, they pull back, and they go into a trading range. And for all intensive purposes, since Friday, we've been in a trading range on the pound Aussie. And yesterday, specifically, we were in a 50 pip box. So again, timing-wise, I was content just to, for this, I'd take my 50 pips. It slowed down, and eventually got the 50 on the one last push through, and that was it for me. I was playing floorball last night. But I wanted to also show a trade on the gold. To me, this is just the epitome of a textbook example of the high and the low of the previous day. 12 candle window, small little doji, London open, third candle engulfment back inside of the previous day's low. Immediately moves towards the high of the day. So we move up to not only the high of the Europe London 12 candle window. So once we clear this level, I'd be at break even. And again, even on this lower swing high, we get the big move through, I'm at break even. As soon as we clear a level, we're at break even. The market goes into consolidation. Okay. We head into the 12 candle window. We break through the high of the day. The next target is the previous day's high. And we went from low to high. Traders are in the breakout short. Other time frame traders, maybe funds, small retail traders, whatever. And their stops are probably sitting up here. They went from here to here. And that just says it all. Low of the day, high of the day, in and out. And here we are back inside of the trading range. So if it doesn't hit the blue line, I'm working off the high and the low of the day. Just real quick, we'll go over the pound yen. So this was the only pair, if I recall correctly. We'll just have a quick look. Pound New Zealand also did not break the blue line. But so we broke out and we came back 1, 2, 3. Engulfment, pin hammer, third candle of the equities hour, and look where it sat on top of. Breakout, pullback, continuation for the trend trade. So in retrospect, this was probably the best trade setup. We showed that initial breakout in Asia before pulling back. And although I felt the pound Aussie was going to move better, we had a strong breakout and a continuation. This market moved 50 pips very quickly, went into consolidation, and continued for a second 50 in the U.S. session. So you win some, you lose some. You just focus on mastering and executing the trade that you're in to the best of your ability, and you move on to the next trade. Just in closing, I wanted to just show the pound Canadian. We have news this week. Thursday we have Bank of Canada Governor Macklem, and of course we have the Fed on Thursday, which I guess is probably Thursday morning, my time. But we have also unemployment on Friday on the Canadian dollar. So we have a double inside bar from Friday and Monday formed on the pound Canadian, and we had a move off the low in September, a consolidation, another push up into the end of the month, a 1 bar pullback, and now we have had a double inside bar. So This double inside bar could potentially be the beginning of a bigger move. Most importantly, through the high last Wednesday. But if that market false breaks and reverses, we could see a move back down, maybe even down towards the lows. But that double inside bar could be a powerful compression pattern. It may not eventuate into anything, but again, just looking at these narrow range days in our Monday to Friday cycle, we could see some big moves towards the end of the week. So hopefully you got some value from today's video, traders. Keep getting better. Keep it simple. High and low of the day. Timings, specifically that equity hour. And may the markets go with
Hi
you.
traders, it's Stacey Burke from Stacey Burke Trading. If you haven't done so, please head over to my website at staceyburketrading.com. I create updates on almost a daily basis, and I would love for you to receive them. Just click on the blog. If you want to enter your name and your email address, I'll send you my free audio program, the 7-Step Daily Routine for High-Performance Traders. This is essential knowledge for all traders in all markets, and this is for helping traders to master the market with discipline, confidence, and a winning mindset. I appreciate all your feedback and comments. As always, traders, stay disciplined, and may the markets go with you.